In this video, we will see about the forwards, futures, and then options in detail. So let's first of all see about what is this forwards. So forward is a contract between two parties and who is going to either buy or sell an asset at a certain future date and also at a certain future price. Um, that is actually decided on the day. All these things all will be mentioned in the contract. So everything that is the date as well as the price, everything will be pre-decided in the contract itself. And the future price is called the forward price, and then the future date is called the expiry date. And this forward contract is a private contract. That means it is not traded in the stock exchanges. So thus we can say this forward contract is an agreement between two parties in which one party, maybe the buyer, enters into an agreement with another party, that is the seller, that he would buy from the seller an underlying asset on the expiry date at a certain forward price. Therefore, there is a commitment by both the parties to engage in a transaction at the future date with a price set in advance. So, but this is actually different from the spot market. In the spot market, there is immediate payment as well as the immediate transfer of asset. So here, the party who agrees to buy, right, on a future date is called as a long investor. The party who buy is called a long investor, and also is said to have a long position because he is actually buying the asset to hold it, expecting that the asset price may fall or it may go up according to his expectations. So he will actually hold it for a long time. That's why it is called long position. And the party who sells this asset is called a short investor, and he is said to have a short position on the asset. So these two parties would have agreed on a price, and that price is called the delivery price or the forward price. So forward contracts are mostly traded in the over-the-counter market and not in the stock exchanges, as I already told. So it is actually done by negotiating with the parties concerned in the contract. So now let's see like how these forward contracts are settled. So the settlement of the forward contract happens in two ways. One is the physical settlement, another one is the cash settlement. So physical settlement, a forward contract, if we take about the physical settlement, um, it actually can means happens by the actual physical delivery of the underlying asset by the short investor to the long investor. So that is from the seller to the buyer. And also the payment is actually as per the agreed forward price, and also the date is as per the agreed expiry date. So let us take a simple example to understand this physical settlement of forward contracts. So there are, let's say, two parties A and B, and both of them are entering into forward contract as of 1st August 2009, wherein A agrees to deliver 1,000 stocks of Ultratech to B at a price of, let's say, rupees 100 per share on let's say 29th August 2009. That is the expiry date, and this is the forward price. In this contract, you can say like A has committed to sell the 1000 stocks of Ultratech at rupees 100 per share on 29th August as a short position because he is trying to sell. But this guy who is going to buy this on 29th August 2009 is going to have a long position. So when the August 29, 2009 comes, what will happen is A has to actually deliver this 1000 stocks of or shares of Unite Ultratech to B. So and B has to pay the price of 1000 into 100, which is going to be uh, 1 lakh, right? To A for receiving this 1000 shares of Ultratech. In case suppose A is not having this 1000 shares to deliver on this August 29, then he has to borrow or he has to purchase it from the spot market and then he has to deliver it to the B. So on this expiry date, okay, the profit or loss depends upon the settlement price. Um, the closing that the settlement price is usually the closing price of that particular Ultratech share on that 29th August. So usually the closing price how it is calculated is it is the weighted average price of the underlying asset during the last half an hour. Okay, so weighted average of the underlying asset during the last half an hour in that day. Uh, so there are actually depending upon the closing price, there are actually three types of scenarios that are possible. The number one scenario is let's say the closing price that is a spot price on the 29th August 2009 is greater than the forward price. So closing price, let me note this as spot price as ST is greater than the forward price. I will denote this as FT. This is one scenario. Another scenario is this closing price, that is the spot price is equal to the forward price. Third scenario that is possible is the closing price, that is the spot price, is less than the forward price. So let's take scenario one. So let's say on that day, closing price of the stock is 105 on 29th August 2009. Then what happens is uh, we can buy 1000 shares of Ultratech at rupees 105 from the market from A. But since A is not having this this 1000 shares of this Ultratech, he has to actually borrow or he should actually buy from the spot market at rupees 105 and he has to sell it to the long investor at rupees 100. Therefore, the person who has a short position makes a loss of uh, let's say 5 per share, right? So there are 5000 shares, so he makes a loss of 5000. And the long investor who actually buys on that day, he actually makes a gain of 5 per share of that is around 5000. So here there is a loss and here there is a profit happening. So the scenario 2, the closing price is equal to the forward price, the same as the forward price. So here neither party will gain, no gain or no loss for both the parties. In the third case, um, the closing spot price is less than the future price or the forward price. So in this case, if we say it has rupees 95 for the Ultratech share on that August 29, 2009, the short investor who has sold this Ultratech that is the A in our case, right? Who sold this Ultratech would make a profit of okay 5 per every share. So since there are okay 1,000 shares, so you will make okay 5,000 okay rupees out of it. On the okay the long position guy will make a loss, which is equivalent okay of the gained by the short investor. One more okay the thing is the disadvantage associated with the this thing physical settlement is, since there is actual okay delivery of asset being okay delivered, there is a huge transaction cost in terms of actual purchase of securities by the party holding a short position. Huge transaction cost will be there, and a transfer of yeah, that's it. So there is a huge transaction cost. Second is, if the party in the long position is actually not interested in holding the security, then he will have to incur further transaction cost in disposing of the security. So that's the reason why okay people go for cash settlement. So let's talk about cash settlement. Cash settlement does not actually involve any actual delivery or receipt of security. There is no okay receipt or delivery of security in this case. Each party pays cash equal to the net loss arising out of the respective position. That is, as I told in the previous case, what happens is in the case of physical settlement, what happens is I have to buy 1,000 shares of Ultratech and then I have to sell it. Okay, let's say I am A, then I have to sell it to B. Okay, uh, each share at let's say 105 rupees. In case okay the spot price is greater than the forward price. So this happens here. So here there is a transaction cost involved for buying this thing. But in the case of the cash settlement, since there is no buying or selling of the security, I will be only paying the difference. Okay, this is 5 rupees, right? So I'll be incurring a loss. So this loss of 5,000 rupees I'll be paying to B. That's it. That I will not buy any security in this case. That is actually the cash settlement. So each party either receives cash equal to the net loss or net profit arising out of their respective position in the contract. So in case of scenario one, as I told, okay, that is the in this case, here the person who is holding the short position will incur a loss of 5,000 on the expiry date, and the other guy will be gaining a profit of 5,000. Whereas in this case, the person who is holding the short position will gain a profit of 5,000, and the person who is holding the long position will have a loss of 5,000 on the expiry date. And also in this case, if you see, there is no loss or no gain. Okay, in the case of cash settlement. That is one difference, because in the cash settlement we only see the difference in the stock price and then accordingly we will pay them, instead of okay buying the underlying asset and then okay pay. That's what happens in the case of physical settlement. Now let's talk about the uh, okay uh, this thing, a default risk in the case of forward contracts. What happens is there is one party A, another party B. They are actually meeting the over the counter market, and they are actually having their own okay private negotiations. Okay, and B is agreeing after 1 month that he will actually buy from A this 1,000 shares of Ultratech. What if okay uh, you know uh, B is not able to buy from A on that day? Or what if A is not able to deliver B 1,000 shares of Ultratech on that day? Then there is a default risk arising here. So regardless of whether the contract is for the physical or cash settlement, there exists the potential for one party to default. So it could be either the buyer or the seller. So this results in the other party suffering a loss. The risk of making loss due to any of the two parties defaulting is known as the counterparty risk. So for A, B is the counterparty. So the risk arising from B is the counterparty risk for A, and similarly vice versa for A. The main reason behind such a risk is the absence of any mediator between the parties. Because there is no mediator, you just meet A and B. A meets B, B meets A. That's it. Nobody is overseeing what's happening here. So there is no mediator between the parties who could have undertaken the task of ensuring that both the parties fulfill their obligations arising out of the contract. So this is also called as a credit risk in case a party defaults. So three names we have seen for this particular scenario. So this thing is quite common in the forward contracts. So in the forward contract so far we have seen like what is a forward contract, and then we have saw about the types of settlement in the forward contract, and we got to know like in physical settlement we have to actually buy the stocks at that price and then we have to sell. So there is huge transaction cost involved. Let's say like there is 1,000 shares of Ultratech I am planning to give to some guy at 30 days from now. From 30 days from now, so at a price of let's say 100 rupees, then I have to actually procure the share, 1,000 shares. Okay, to procure the 1,000 shares I should have around 1 lakh in my pocket, right? So there is huge transaction cost actually possible here. Okay, so this is actually avoided in the case of cash settlement that also we saw. So wherein I need to only have let's say the difference in the price that is arising. So in case let's say the 100 rupees share has become 105, so the person who is going to have a short position should have only 5,000 in his pocket to pay to B. Okay, on the other hand here it is very difficult. He should have 1 lakh 5,000 in his pocket in the case of this physical settlement. So this transaction cost is how it is limited that we saw, and then we saw about like three different scenarios that may be possible during the settlement, and also we saw about the default risk. Now let's see about the futures contract. So what is this futures? So like a forward contract is also if agreement between two parties in which the buyer agrees to buy an underlying asset. Okay, so there is underlying asset here also from the seller at a future date, also at a future price, future price, but this price is actually pre-agreed upon today. But only one difference in that is that it is having, this is not a private contract. This is a contract that is actually executed in the stock exchange, the to on a recognized stock exchange. So all the terms other than the price are set by the stock exchange. Okay, except the price, everything is set by the stock exchange. Um, Also, both the buyer and the seller of the future contracts are protected against the counterparty risk. That was one of the major drawback, right? That this, so they are actually protected from the defaulting risk. So, or credit risk in the case of future contract. The clearing corporation actually provides this guarantee to the counterparty defaulting in case the counterparty is defaulting on its obligation. In case one of the party defaults, the clearing corporation seeks to fulfill the obligation of the party so that the other party does not suffer due to the non-fulfillment of the contract. To have this ability to guarantee the fulfillment of obligations, the clearing corporation usually holds an amount as a security from both the parties. So this amount is called the margin money. So there is something called margin money in the case of the future contracts. and it can be as usual in the form of cash or any other financial assets, the payment of this margin money. And also, since the future contracts are traded on the stock exchanges, the parties have the ability of closing out the contract prior to the maturity by squaring of the transactions in the market. So this is how the future contract happens. There will be a seller, there will be a buyer. So in between them, there will be the clearing corporation. So what happens is seller sells the future contract to the clearing corporation, and the clearing corporation, um, you know, sells it to the buyer. So the buyer actually buys from the clearing corporation. So in turn, the buyer okay gives a payment to the clearing corporation, and the payment is actually being forwarded to the seller. So payment and the payment, and then okay here it sells and here it buys. So let's see what is the major difference between the forwards and the futures. What is it? Difference between the forward and the future. Already we know in the case of forward we have contracts that are privately negotiated okay contracts. In the case of future, it is traded on the exchange. And second thing I would say is like this is not standardized because it's all based on the negotiations between the two parties. Whereas these are like standardized contracts. Except the price, everything is set. Date, underlying asset, everything is set. And the settlement dates can be set by the parties, as I said already. So here the settlement date is as per the exchange okay determination. And also there is a high counterparty risk okay possible, but in this case there is no almost I would say no counterparty risk, and they are actually able to do it as I said because of this margin money concept. So now let's see about the third derivative, that is the options. So like forwards, unlike futures, options are also derivative instruments that provides the opportunity to buy or sell an underlying asset on a future date. But there is one difference. So it's a derivative contract again between a buyer and a seller, where one party gives to other the right. This is a very important thing. Okay, one party gives to other party the right, but not the obligation. But in the case of future and the forwards, he has to actually buy that underlying asset, or he has to okay. There is some okay obligation on it. But in the case of this thing, he has only the right, but not the obligation to buy the underlying asset. So this is the basic difference between the options and the forwards or futures. So this usually right uh, one party gives to other party the right but not the obligation to buy from the first party the underlying asset on or before some specific date at again but at again a predetermined price. So in return for granting this option, the party granting the option collects a premium. That premium is called the price of the option. So you have to pay something for okay getting this contract, that is called the price of the option, and this is called option premium. So it's not free that he gets this right. Suppose let's say like there is a land available and it belongs to A, and B approaches to buy this land, and E actually got to know that the price of the land is let's say 1 lakh, but at the moment B is not having the money. He's having let's say like only 80,000 in his hand, so he can't pay it right now, right? So he's saying like after 30 days, parent, you will get the salary. So you will be in a position to pay him the 1 lakh which A was asking for. So you would say, give me 30 days, don't sell this land to anyone. So A is okay agreeing to it, but A is asking him to pay certain token advance. Let's say like he is asking to pay him 5,000 rupees for 1 month. Okay, so B gives A the 5,000 rupees to hold this land for 1 month. After 1 month, there are two chances that are possible. Uh, A may come and buy this land, or A may not come and buy this land. If A comes and buy this land, then he will pay 1 lakh and then he will buy this land. Or else, if A is not actually happy with the land, then this 5,000 belongs to A. So for this, for holding this land for 1 month without okay, for only exclusively for B, uh, A is A has protected himself against the defaulting risk of B using this 5,000. Now after this 30 days, now again A can sell the land in the market or throw the land open to the market for sale. So this 5,000 is the option premium paid by B to the A. The right to buy or sell is held by the option buyer, also called the option holder. The party granting the right, okay, is the option seller or the option writer. In this case, this guy has the right to buy in that 30 days only. No other has that right to buy. So this guy is the option buyer here. B is the option buyer here. Whereas A, if you take, E is the option writer or the option seller. So unlike the forward contracts and future contracts, option require a cash payment upfront. You have to pay this 5,000 rupees, that is the option premium, okay, at the time of entering into the contract itself. So options can be traded either on the stock exchange or in the over the counter market. Options that are actually traded on the exchanges are backed by the clearing corporations and thereby minimizing the risk arising due to the counterparty risk. That is the default that happens because of the counterparties involved. So options traded in the over-the-counter market, however, are not backed by the clearing corporation. So that is one thing we are actually one advantage we are actually having by exercising the option through clearing corporation. So there are two types of options available. Let's see what are they. One is the call option, and another one is the put option. So call option is an option granting the right to the buyer of the option to buy the underlying asset. So call option is the right to buy and put option is the right to sell. Let's take a stock. Okay. Uh, a stock is, let's say, trading at 100 rupees as of today. After 30 days, okay, nobody knows from now onwards exactly what the price will be. But let's say like there is one party called A, another party called B. Okay, so um, B is actually thinking B is actually thinking that this stock that belongs to B, some stock, let's say XYZ, that belongs to sorry A, will go up to 110. Okay, but A on the other hand thinks like, yeah, it won't be like that. the price may fall down, let's say 95 rupees. Okay, there is one more situation possible. Okay, the price may be the same also. So now let me explain the call option. So in this case, B who is thinking that the price of the XYZ will go up to 110 will buy call option on this day itself. Let's say this is the 1st August and this is the 30th August. Okay, so he buys the call option for uh, for 30 days up to 30th August. So after 30th August, this call option will not be uh, effective, or it will not be okay valid. So what happens is, after, okay, now let's say, now let's travel down to the 30th day. So now let's see if we see in the stock market, the price of the stock XYZ is now 110. Now what B can do is, B will exercise this call option so that he will buy the stock XYZ on the 30th August at rupees 100, even though the market price is 110. So now after buying this, B has a choice of, okay, selling this back into the market at 110. Thereby he makes a profit of 10 rupees. Here, let's say, like, if the option for buying this, okay, call option, if B spends, okay, 1 rupees, then the actual profit is 9 rupees, because this one is a sunken cost, so sunk cost. This is scenario 1. Scenario 2, I would say, is the this one. So it happens as per the A's thinking. Okay. So now what A can do is, A can A has a right to sell. Okay, so A on that, okay, 1st August has entered into a okay, sell option, which is the put option. He has a right to sell this asset at 95 rupees on 30th August. Okay, so as per the expectation, on that day the price of the stock was 95 rupees. Okay, but he bought it at 100 rupees, so he will sell it at 100 rupees. Okay, even though the stock market price is 95, he will sell it at 100 rupees, because he has actually entered into a put option on the 1st August itself, saying that I have the right to sell this stock at 100 rupees. Okay, even though the stock market price, or the market price on that day, is 95 rupees. So what he will do is, he will actually get a profit of again 5 rupees in this case. And let's say, like that, it was around zero point 0.5 for, okay, procuring this contract, then the effective profit will be 4.5 rupees. So in this way, A can exercise a put option if he has bought put option on the 1st August itself, to sell the stock at 100 rupees, even though the actual price is 95 rupees. And let's say the third scenario, wherein the price of the stock is remaining the same. In this case, um, neither of the party will exercise, okay, the option. B in the case, okay, call option, and A in the case put option. And obviously both of them will be incurring, okay, in real world, a loss of whatever amount they spent on the procurement of the option. Let's say, like, B has spent 1 rupee on the option, so you'll be incurring a loss of 1 if he say, okay, sells. And also at the same time, the, okay, contract matures, right? So you'll be incurring a loss of 1, and A will be incurring a loss of zero point 0.5. So this is all about, okay, call option and the put option. So now let us take another illustration. before that, let's see about the difference between the futures and the options to revise our concepts. So we know in the future both the buyer and the seller are under the obligation to fulfill the condition. Okay, both have the obligation. But here there is no obligation. We have only the right. The buyer of the option has a right and not an obligation, whereas the seller is under the obligation to fulfill the contract if and when the buyer exercises the right. And also the buyer and the seller are subjected to unlimited loss, unlimited risk or loss. Here we don't know how much it is, right? But the seller is in the case of here the option, the seller is subjected to the unlimited risk of losing, whereas the buyer has a limited potential to lose, which is the option premium. Here both of them will have the risk of losing. Here only the buyer is having the limited potential to lose, but our seller is having the unlimited risk of losing. In the case of the land example, if we take, we may never knew like how many people would have like bought the land. Let's say like we may have one guy called C would have actually bought had A met C instead of B on that day. B was not having enough money, that is 1 lakh, so he said and that he need 30 more days, and he requested for that, and he granted the right to B. That means he sold the option to B. So A B exercise the option on after 30 days, or he may not exercise the option after 30 days. So in either case, B has limited risk of losing, limited potential of losing money, whereas A has unlimited risk of losing money. The buyer and the seller have the potential to make, again, if there is a loss, then they also on the other hand have the unlimited gain as well. The buyer has a potential to make, here the buyer has a potential to make unlimited gain, again the seller has a potential to make unlimited gain, both of them. The reason is because let's say after okay 30 days, suddenly due to some government projects that are being initiated and new roads that are being laid that particular near the particular land, and maybe some treasure is gold is being found in the land, the buyer will buy, even though the land value let's say increases to 5 lakh, the buyer will just pay 1 lakh and then reap the benefits from that land. So there is unlimited gain for the buyer. Maybe after 30 days the buyer is not turning up, so the seller has found another party who is ready to pay that 5 lakh, okay, because of all those extra developments and found findings that happen. So yes, again the unlimited gain. So now let's see with respect to this option few terminologies. Already I told spot price. Spot price is the uh, price that is quoted for the immediate delivery of the asset, and also the forward price or the future price is a price that is agreed upon the expiry date of the contract. Okay, these prices are actually dependent on the spot price, obviously, the prevailing interest rate, obviously, and then the expiry date of the contract. So, how much I will charge? That actually depends on the spot price as of now, interest rate, that's very important thing, and then the expiry date of the contract. Higher the date, higher will be the price, and also interest rate, it also matters. Higher the interest, again higher will be the price, and spot price higher, again higher will be the price. And another one is strike price. This is another important terminology. So strike price is the price at which the buyer of the option can buy the stock in the case of call option, or sell the stock in the case of put option on or before the expiry date of the option contract. It is a price at which the stock will be bought or sold. when the option is exercised. So when the option is exercised, what was the price of the stock? That is the strike price. This is okay during option exercise. And then we have something called expiration date. What is the expiration date? As I told, that is the maturity date of the contract. It's also called the final settlement date. And then the options also can be divided into two categories, which is actually based on the exercise style. Like based on the exercise style, exercising of the option, we can actually divide it into two types. That is the European option. Another one is the American option. So in the case of European option, or the option that can be exercised only on the expiry date. Okay, this can be only exercised on the expiry date. You cannot do it on any day before the expiry date. Whereas the American option, on the other hand, it's as it says, okay, it can be exercised on any day. Any day you can exercise it. That's what I mean by exercise time. Okay, so they can be exercised by the buyer on any day on or before the final settlement date or the expiry date. So now that we have seen that, now let's see about what is called contract price. So what is contract size? Contract size, as futures and the options are standardized contracts traded on the exchange, they definitely have fixed contract size. Sorry, futures and options, and also these are like exchange traded, and that's the reason why they have fixed contract size. One contract of a derivative instrument represents a certain number of shares of the underlying asset. For example, let's say like if one contract of bill contains BHEL, I'm talking. Okay, bill stock contains okay 300 shares of bill. Then if one buys one future contract, then obviously uh, for every 1 rupee rise in the bill share, I will be actually making a profit of piece 300 if I am going to be the long investor or going to take a long position. And one every again the same case, for every 1 rupee fall, I will be losing rupees 300. What is the contract value? So contract value is the notional value of the transaction in case one contract is bought or sold. It is the contract size multiplied but the price of the future. Contract value is used to calculate margins for contracts. For example, say like if the futures, bill futures are trading at 2000 rupees, the contract value will be 2000 into 300 because one future is represent 300 shares. So the contract value is 2000 into 300, which is around 6 lakhs. Now let's see something called margin. What is this margin? So in the spot market, the buyer of a stock has to pay the entire transaction amount to the seller. For example, let's say like if Infosys is trading at let's say rupees 2000 per share, and investor wants to buy 100 uh, shares of Infosys, then he has to pay around 2 lakhs to the seller. The settlement will take place after 2 days. In derivatives contract, a person enters into a trade today, but the settlement happens on a future date. Because of this, there is a high possibility of default by any one of the parties. The future and the options contract are traded through exchanges, and the counterparty risk is taken care of by the clearing corporation, as I told. So how do they do that? I also told that, like in order to prevent any of the parties from defaulting on a state commitment, the clearing corporation levies some margin. That is called margin money, I told. Okay, so this margin is actually a percentage of the total contract value. Let's say like if a person wants to buy 100 okay Infosys share, then he will have to pay let's say 20 percentage of the contract value as the margin. That means in this case 20 percentage of 2 lakhs, so it will be around 40,000 just to pay as a margin to the clearing corporation. So this margin is applicable both to the buyer as well as the seller. Both of them has to deposit this margin money to the um, stock exchange in case they are involved in the derivatives contract, particularly the futures and the options. And there is something called moneyness of an option. Let's talk about that. So moneyness of option indicates whether the option is worth exercising or not. That is, if the option is exercised by the buyer of the option, whether he will receive money or not. So moneyness at any time depends upon the spot price of the underlying asset. That's a very important spot price of the underlying asset, and how it is related to the strike price. So spot price, how it is related to the strike price. So in this way only we will determine the premium paid. That is, let's say like in the case of option, we are paying option premium, right? That is not actually taken into account since the premium paid is a sunk cost. It's irretrievable. Okay, once paid is paid, right? It's irretrievable. You have to therefore the decision of the buyer of the option whether to exercise the option or not is affected by the size of the premium. Sorry, it's not affected by the size of the premium. So when I say about moneyness of the option, I will not actually think about how much premium I paid to arrive at okay whether to buy or exercise the option or not. So it is no way dependent on the premium. So there are actually three scenarios possible, as I already told. One is in the money, other one is at the money, another one is out the money. So an option is said to be in the money if on exercising the option it produces a cash inflow to the buyer. Thus the call options are in the money when the value of the spot price exceeds the strike price. Okay, spot price exceeds the strike price. And put options are in the money when the spot price is lower than the strike price. Okay. Um, let's say like I am having 100. I on August 1 I bought a call option where the stock price was 100. After 30th day the stock price was 110. So I am going to exercise the contract. So here the strike price is more than the here the spot price is more than the strike price. So I'm obviously going to incur a cash inflow in this case of about 10 rupees. Let's say I have entered into a put option at 100 rupees on August 1. After 30 day the price was 95. So now I have the right to sell the option put option at the 100 rupees even though the market price is 95. So I will be incurring a profit of 5 rupees. So again here if you see, this is the spot price and this is the strike price. Spot price is less than the strike price, and that's why I'm getting the cash inflow. And also it should be noted that the moneyness of the option should never depends upon the premium paid. So thus a holder of in the money option did not always make profit, as the profitability also depends upon the premium paid. But however in the real world we need to take into account the premium also. If I pay 1 rupee at this day, then it is obviously 9 rupees. If I pay 1 rupee here, then obviously the profit I made is 4 rupees. Now let's see about out of the money option. Out of the money option is an opposite of in the money option. Option holder will not exercise the option when it is out of the money. So call option is out of the money when the strike price is greater than the spot price, And also for the put option, the strike price is less than the spot price. And at the money option, it is option in which the spot price of the underlying asset is equal to the strike price, and there is no gain or no loss. There will be no cash inflow or cash outflow in this case. Okay, that's it as far as this video is concerned, and thank you for watching this video.